Welcome to Market Call. I'm Morella Fernandez. Thanks for joining us today. Gordon Reid with us, President and CEO of Goodreid Investment Counsel. He'll take your questions on U.S. equities. Here's how to reach us. 1-855-326-6266. You can also email questions into marketcall@bnnbloomberg.ca. Gordon, good to see you.
Nice to see you, Morella.
Let's talk a little bit about the Fed chair who will speak later this week. What do you expect to hear from Jerome Powell?
I think he's probably going to be quite cautious. Obviously, there's a lot of moving parts. We saw the labor statistics last time show some cracks in the labor market. He's got another labor print before the Fed meets again. So I think he's going to want to see that before he indicates or messages what he might be leaning towards. And also the inflation numbers in the United States have been sticky. In particular, how they're comprised. So the service side has been a little stickier. It's a little tougher to bring down over time. So there's some challenging issues for the Fed, to say nothing of the pressures that they're getting from the administration, and that, of course, is weighing on everybody and their expectation of what might happen.
Do you think then we will get the same line we've heard from him for the past few times, which is we're waiting for the data, because as you mentioned, he still has some key indicators that he's waiting to hear about in the next sort of 6 weeks?
Yeah, I think it's exactly that. I think he's going to say that it's going to be data dependent, that they're carefully watching the labor market. He's going to reemphasize what the mandate of the Fed is, and leave it at that. I'd be surprised if he showed his cards.
I guess it's less than 6 weeks now. It's about a month. Let's talk about the bull run that does seem to carry on, despite some of the, I know you've referred to them as cracks in that case. What are you seeing as far as a bit of a change of direction?
Well, not really a lot of change in direction. It's still a fairly narrow market. It's being led by relatively few sectors and relatively few stocks. The communication services area has done extremely well. Stocks like Amazon and Meta and Microsoft, the old Mag 7, I guess we could still call it that. But, on the fringes, industrials, of course, have done quite well. Healthcare has not, energy has not, consumer discretionary, especially the lower end or lower demographic, consumer discretionary has struggled. So there's a bifurcation in the market. That's not that unusual, especially as bull markets mature. They tend to get more narrow as they mature, and that's what we've seen.
Some are saying they're beginning to see some interest in the smaller caps. Are you seeing any of that yet?
Well, that's interesting. The Russell 2000 hasn't done particularly well. At Goodreid, we operate a U.S. mandate in the small cap area, and we've had great success. So we think that there are nuggets out there. If you're a good stock picker, if you turn over the rocks and find the hidden values. That's one of the great virtues of small cap space, is that they're not heavily covered, so there can be some mispricing. And certainly our experience at Goodreid with our U.S. small cap composite has been very positive, but we recognize that the Russell 2000 has struggled. As interest rates fall, that's going to benefit the small cap space. Small cap companies, are generally higher levered. They have less creditworthiness, so that generally lower interest rates favor small caps.
Got it. Okay, we are going to leave the conversation there. We'll line up some phone calls and some emails for Gordon Reid, Goodreid Investment Counsel. He's taking your questions today on American equities. Here's how to reach us. Back in a moment. Welcome back. Let's start with an email from Chris. He says, hello, Gordon. May I please have your current thoughts on Elevance? Elevance, is it a stock you know well?
It is. It's a stock that's in our U.S. large cap portfolio. It's been a challenging stock, without question. It's been a challenging sector. United Health is the...
beaten down a lot.
Yeah, the big one in that sector. Elevance is the old Anthem. and Anthem is in the same business as United Health generally, which is the health insurance business. And they've got about 47 million Americans who are covered under their programs, Medicare, Medicaid, some government, some commercial. There's some differences in the businesses and how they operate. Elevance's business plan has about 60% of their coverage based on a fee-based model. And that fee-based model, as opposed to a risk-based model, means that they pass along or pass off some of the risk associated with outcomes. So employers take some of that risk. So they might say to you, Morella, you've got a workforce of 40, and here's the rate that we're offering you for your coverage for your group. You come back to them and you say, but my workforce are all generally young people, they're healthy people, why are my rates so high? So they would come back and say, okay, well, if you're willing to take on some of the risk over a set amount of liability, we'll lower your rate. That's a fee-based system. And Elevance has about 60% that way. We thought that would insulate Elevance somewhat from some of the buffeting that is happening in this industry. It turns out we were wrong. It really didn't. They suffered from the same issues of utilization problems, where coming off COVID, a big cohort of young, healthy people
We're catching up.
Well, they were catching up, and they qualified for Medicaid because a lot of them lost their jobs.
Got it.
So a lot of the pricing reflected the fact that there wasn't a high utilization. All of a sudden, they're getting kicked off the rolls. The utilization rates are rising. On top of that, people who put off procedures because of COVID are now going to have those procedures done. So the medical cost ratios in this whole industry are all over the place, and they're tending to rise, and the prices haven't caught up. That's where they got
stuck.
That's the core issue, exactly.
Yeah.
Exactly, that's where they got stuck. What's going to happen, though, is that pricing is reactive. So 2026 pricing is going to react to the utilization rates of 24 and 25. So they're going to get big price increases. I've read about Medicare price increases pushing 20%. So they're going to get that. And we're looking at what's going to happen to the medical cost ratios. Are utilization rates going to rise or fall? We think that they're going to come more into line, which will expand margins. Now, these stocks have been pummeled. What happens when margins expand, profitability increases? Are we going to see a V-shaped bottom? We think there's a possibility of that. Are we at the bottom? We don't know. But we think that these are historically cheap prices for these franchises. They're not going anywhere. They just have to get their business models in order.
So essentially, if you have it, hold it.
That's our view. And in fact, we've added to Elevance. But you have to be careful, because you don't know in this environment just where the bottom might be made.
Yeah.
And it's usually lower than where you think.
Okay.
So if you have a long-term view, if you're not going to be scared out with a portion of your portfolio, and that's important, is not to bet the farm, but take a piece of your portfolio, allocate it here, and just have this set aside for future benefit.
Got it. Okay, we hope that helps Gordon. Hope Gordon has helped him out. Let's go to Jim, who's in Elliott Lake, Ontario, with a question today. Hi, Jim.
Hi, good afternoon to both. Hi, Gordon.
Hi, Jim.
One of my favorite guests. Just your thoughts on Abbott Labs. We can see it's done quite well, both short-term, long-term. Your general thoughts on it, maybe post-COVID, if you will. But if not Abbott, could you recommend something else, within the same space?
Yeah, Abbott's not a stock that we own, but we have owned it in the past. It's a very stable company, healthcare company, pays a nice dividend, very reliable dividend. I believe that they have a record of us. I forget exactly the number of years, Morella, but it's something like 60 years of increasing dividends, like a very, very long record that they take very seriously. So a lot of investors in Abbott are there for the dividend, for the reliability of the dividend. The dividend isn't taxing. They have enough free cash flow to cover it.
Okay.
And it's a good, stable company. It's not going to be an Eli Lilly. It's a stable company. But the dividend, together with modest capital appreciation, makes up a good piece of a portfolio.
If you wanted to put something or pull something out of this spot and move it into another stock, is there something comparable that could have more growth, for example?
Well, I think probably something like Amgen has some potential to have more growth. Some of their drugs are growthier, offer more appreciation, and they are on the fringes of the GLP-1 technology with a phase 3 drug called Maritide, which could allow them to enter that race, which would be additive to their valuation. They'd get certainly a bump in terms of their price to earnings ratio, for example.
Got it. Okay, let's move on to John calling us from London, Ontario today. Hi, John.
Thanks, Marilla. Hello, Gordon. Gordon, our
John.
youngest, just turned 18, and he's off to a good start in his fledgling portfolio with Broadcom and Home Depot.
Good.
I thought about, for a next choice, maybe FinTech, so MasterCard or Visa, or maybe industrials, GE or Honeywell. What do you think of that? Thanks very much.
Okay, so for a brand new investor trying to sort of diversify a little, is FinTech a good idea right now?
Certainly financials are a good idea. So if you're building a portfolio, you have to have, first and foremost, a broad enough number of companies to diversify so you avoid, company-specific risk. And then once you've developed the number, you want to look at it and make sure you're in enough sectors and industries. So certainly financials, FinTech is one area. We own Visa in our portfolio at Goodreid. We like it more than MasterCard in that it's a little more attuned to what we think is advancing in this day and age, more debit cards as opposed to credit cards, more sort of instant transactional business against individual accounts.
Right.
It trades about 5 turns cheaper than MasterCard. Doesn't have the international exposure that MasterCard has, but it's a little bit cheaper. So we've chosen Visa, and we've owned it for many, many years. It's very consistent, high earnings predictability. So I think it's a really good component for what Jim's looking for.
Got it. Okay, we are going to take a quick break. We'll be back with Gordon Reid, Goodreid Investment Counsel. He's taking your questions today on U.S. equities. We're back in a moment. Stay tuned. Welcome back, and thanks for joining us on Market Call. We're going to Michael on the line in Toronto with a question. Hi, Michael.
Hi there. Hi, Gordon. My question
Michael.
is about Apple. Now, I know there's been a lag with their AI release, but my question is, eventually, when they do end up releasing it, do you see big upside potential in that stock? Thank you.
Okay, thank you for the question. They did report last quarter, did very well with their phones, which might have been people buying ahead with the tariff, uncertainty. And they are now investing more in the U.S., which is very much a demand of Mr. Trump.
Right.
But AI, they've been lagging in AI.
Yeah.
Is that somewhere you can see them catching up? And what does the future look like for Apple?
Well, I think the future is bright. But if you look back at Apple's playbook, it's often that they allow other people to invest in the nascent technologies, make their mistakes, and then in the second, third, and fourth inning, Apple steps in and captures the whole space. They did that with music, they did that with the phone, and I wouldn't be surprised if that's their game plan here. I think that a lot of it's built in already to Apple. I think people have recognized what I just described. So if you look at it on a multiple basis, it's fairly richly valued. Part of that is because they've shifted their business mix. 28% of Apple's revenue is now service business. So that is a very high margin business. And part of that service business is the apps. So the App Store, which basically Apple owns, is going to be their entry into AI. And I think that it's going to be a big entry, and I think that they're going to be able to monetize it very effectively. So we're an owner of Apple. We have been for, 20 years.
Okay.
And in those 20 years, there's been good times and there's been some poor times. I think we've seen the stock have 3 separate times. And you have to have a lot of faith to see a stock fallen by 50% to stay with it. But we've always thought that if you have a good business model, strong moats against competitors, that there will be ebbs and flows, but wait for the good times. And that's been our experience with Apple.
Along those lines, then, it doesn't bother you, it hasn't come back fully from that April dip like many others have?
It doesn't really bother me that much. I think that from a sentiment standpoint, there still is a bit of negative sentiment on Apple, but as I say, the valuation is still fairly rich. So they haven't. If you think of it another way, it hasn't come back that much from the April thing, but it also hasn't reacted to the fact that their earnings haven't been all that good. I mean, if you look at the last cycle, their revenue and earnings growth has been pretty poor. And you have to have faith in the long-term business model of Apple to stay with it. It can't be sort of looking at next quarter or even the next year.
Got it. Okay, let's go back to the phone lines. Mo on the line from Milton, Ontario. Hi, Mo.
Hi, Murad, first-time caller. Murad, you are the most impressive anchor so far. I've been watching the show since 2018 and like your approach on focused and investigative questions.
Thank you very much.
Benefits investors like me. Question to Mr. Reid. I appreciate for sharing various profitable picks like Chubb and CrowdStrike. Today, my question is about LLY Eli Lilly. Can you please tell more about it?
So Eli Lilly, and we talked about the health space and pharma as part of that, really beaten down, and all of them are trying to push their new drugs, but they don't seem to be having success in some of the trials of translating their newest drugs, which are sort of geared towards diabetes, into weight loss pills necessarily.
Yes, the oral.
Version. Yes. So. What's your take on the space and Eli Lilly specifically?
Well, I think the take on my space is that as Lilly gained, traction and the price just went up dramatically, there was a lot of hype over the GLP-1 space. So that's the first stage of any innovation. So whether it's AI or GLP-1, you hear people talk about the TAM, like a total addressable market, and it goes like, well, it's 150 billion. No, it's 300 billion, and let's add another 100 billion. And the numbers are thrown around very callously. As things mature, you start to get much more precise, and people's feet are on the fire, held to the fire. That's the stage we're at right now, and you've seen Lilly and especially Novo Nordisk, which is their main competitor, fall. In fact, Lilly hasn't fallen nearly as much as Novo has. But to your point, it's about the future, and it's about how they're going to monetize the GLP-1 franchise. The injectable version is owned by Lilly. It was owned by Novo, which was Ozempic. And Wegovy is the competitor, and it has caught up, and it's now taking share away from Novo. But the translation of that towards an oral application has been challenging. It will happen, but who's going to control the space? And then we get into what's the pricing going to be. Just the other day, we saw Novo cut their price in half, from $1,000 a month to $500 a month, and do a deal with GoodRx, I think it was. So they're going to be in, I think, 70,000 pharmacies in North America for people who want to buy it directly. Still a pretty steep price on a monthly basis for the application. Then you layer another worry on, and that is the policy of the United States and
what gets covered, what doesn't get covered, and whether pharma is going to be cheaper, because that's what they're demanding.
So they're saying, Trump is saying that he wants to apply what's called the most favored nation clause. Most favored nation clause simply means that Americans would be guaranteed the best price that's offered in the world, so the lowest price. And that's very challenging because in a lot of jurisdictions, as we know, drug prices are much lower than they are in the United States, largely because of the tradition of insurance getting in the middle of the process of bringing drugs to market. So there's a lot of moving parts here. How profitable are these companies going to be? So we've seen Lilly move from 50 times earnings to 35 times earnings now. There's a lot of promise, but there are also a lot of questions.
Would you hold at this point if you were a holder of Eli Lilly?
Well, I would have been a seller a while back.
Sure, but if you hung on, this
at
being
this point,
a prime company in the space, if you were lagging today at 709 and you held when it was up near 900, would you hold still?
That to me is irrelevant. Okay. Whether you held it at 900, all I care about as an investor is my money today and going forward. That's just history and emotion. So if I held it today, I would ask questions like, what's the percentage of your portfolio that Lilly makes up? How is your portfolio constructed? What are your risk-reward characteristics? How old are you, and when do you need cash? Do you need cash generating out of the portfolio? All of these things that at Goodreid, our portfolio managers spend hours going over with potential clients and existing clients as circumstances change. Very, very important as to how your asset mix is constructed. So all of these things put in the hopper, I think under the right circumstances, I would hold Lilly.
Okay.
But it has to be the right circumstances.
Got it. We're going to take a quick break. We'll be back with Gordon's past picks in a moment. Stay tuned. Welcome back. Gordon Reid is with us today. We're going through his past picks from almost a year ago, August 23rd of 2024. At the time, he picked on the New York Stock Exchange, Despegar.com, which was 1165 US, went to 1950 US, and it was actually acquired mid-May at 1950. So 67% upside for return, same for total return. When did you guys first hold it?
I was just trying to remember when we bought it. We didn't own it a long time, so not multiple years, but probably a year and change.
Okay. And we should mention it's an online booking for travel.
Yeah, they're almost a mini booking holdings company, online travel agent, model, asset light. Really responding to the needs of people in Latin America. So a lot of business in Brazil, Argentina. And if you look at that market, it's made up of a young demographic. So they have a younger population, they're traveling more, they've got more disposable income. It was trading at a very reasonable multiple, probably 60 or 70% of what Booking Holdings was trading at. So it wasn't a challenging multiple, and we thought, well, this is a really good opportunity. We bought it, and not that long afterwards, Process, which is a private equity firm, made an offer for it at 1950, and we actually didn't take the offer. We sold it at 1950 because that was the offer, traded up to it.
Got it. Okay, let's go to your next past pick, which was Freeport McMoran on the New York Stock Exchange, 44.66 US at the time, now to 41.89. So a 6% dropped return and a 5% drop total return. And they do resource. They're a resource company, essentially.
Yeah, copper or gold.
Okay, what's been going on with them?
Well, quite a bit. China is the biggest consumer of copper in the world, and we know the challenges that China has been having. They actually consume more than 50% of the supply of copper. Copper long-term is a winner, and it's a winner because of application. Whether it's power generation or electric cars,
home building.
Yeah, everything. Just a higher content of copper. You just don't develop a copper mine. It's a very slow process of developing. Freeport is one of the largest in the world. They produce about 8% of the world's supply of copper. They've got a very big U.S. presence, the biggest U.S. presence, over 1 billion pounds of copper produced. It's been buffeted around because of the tariff issues. If you watch the stock, it's last week or 2 weeks ago, huge drawdown, fall in copper prices because Trump redefined his tariff to include certain types of copper, but not others.
Yes.
Types of copper. So it's all over the place. This is one where we'll just be patient. We'll wait for the long secular trends to fully develop. We think that copper demand over the next 10 years will double, and that's going to affect the commodity price. And companies like Freeport are highly leveraged to that price and will benefit.
Okay, so that is Freeport. Let's move on to your third pick from last August. General Motors on the New York Stock Exchange, 48.57 US to 57.23 today, 18% upside, 19% total return upside. I'm surprised you picked General Motors, but this would have been ahead of a lot of the tariff announcements. Yeah. Obviously, it's gone up. Would you have bought in today if knowing sort of what is coming out of Washington changes all the time with vehicles and steel and aluminum?
Well, in fact, the way our model works at Goodreid, we do buy in every day because we have new clients joining us virtually every day. So we put it in the model, in the composite, and then if a new client joins us and has, say, 35% of their portfolio designated towards the U.S. large cap portion, then they would buy a piece of General Motors today, yesterday, day before. And only when we decide it should exit the model do clients sell, do we sell on their behalf. So we continue to like it. A lot of headwinds here. I mean, you mentioned them. A lot of headwinds, about a $5 billion charge this year alone because of the tariffs. But this is a company that started off incredibly cheaply in terms of market prices. Enterprise value to EBITDA at about 6 times, making over $10 a share in earnings. And you can see the price, $50-something, and doing the math, 5 or 6 times earnings. Very, very inexpensive. So we're, again, going to bide our time on General Motors. They've got a good model. We like the way they compete against Ford, for example, and even if you move out against Tesla. They've got an electric vehicle program, which, of course, like everybody else, has sort of been pushed off and deferred because it really wasn't adopted and accepted by the public the way people thought it would be and the companies thought it would be. But they're sitting there waiting for the wind to shift to their back as opposed to being in their face. And some of these things they don't control, but they're well positioned. So buy it, be patient, and we think they'll benefit.
Got it. Okay, we're going to take another quick break. We're going to line up some more phone calls and some more emails for Gordon Reid. We're back in a moment. Welcome back to Market Call. Thanks for joining us. Let's go right to Deborah. She's on the line in Okanagan Falls, BC, with her question. Hi, Deborah.
Oh, hi. Good morning, everybody. And kudos to the telephone staff answering the phone. They're great. My question today, Gordon, is on Walmart. My screen is showing that they are going to be giving their earnings on August 21st. And some of the analysts have said that they may reach a price of $115. They're just traded over 102 today. My questions are, do you own Walmart? And more importantly, what is your stance on buying a stock just before the earnings report?
That's also a very interesting question.
Yeah, good question. We don't own Walmart. We find it just a little bit too expensive for their growth metrics. They're a good company. They're well managed. But about 55% of their business is grocery, and grocery has a very, very low margin and not a lot of elasticity. So, So, at the multiple that they trade, we just find it just a little too dear. So we respect Walmart. We like the management, but just can't pull the trigger on the price.
What about whether or not to trade when earnings are sort of a week away?
Sure. I think on the buy side, certainly you should buy before the earnings. You're buying it because you think there's good news coming, that there's optimism, that you're optimistic that good news is coming. On the sell side, however, I would have a different answer, that you want to sell before any impending earnings. Again, same reasoning. If you're selling for a reason, and it tends to be more of a negative one. There's worries there. Something's about amiss with the stock, so you want to get out before the earnings.
Got it.
Call.
Okay. Let's go back to the phone lines, and I want to get to Jay, who's calling from Toronto, Ontario. Hi, Jay.
Hi, Morella.
Go ahead.
I bought IBM at $275. Since I bought it, it's been coming down. Do you think it will come back soon, or should I sell and get into something else?
What's IBM been doing lately?
Well, IBM, of course, has that reputation of being the stodgy, old, traditional, low-tech tech. But that's not exactly true. They have been involved in AI. They've got an alliance with Meta through the Llama AI, open AI concept. Watson, which is a IBM invention, is also being used for AI adoption. But the piece of their business that's holding them back is the consulting side, and it's a very low growth type of business. We owned IBM quite a bit lower than here, bought it because we thought that the market was missing the AI piece of the story. But when it got up into this range, we sold it because we thought that it was more fully valued and there were better opportunities. It continued to move up, and now it's fallen back to about the level that we sold it. I wouldn't buy it at this point, and I would encourage Jay to look at other opportunities in tech that are a little more predictable, a little growthier, and I would point towards perhaps Meta, Microsoft, or even Amazon.
Got it. Okay, Jay, I hope that helps you out. We're going to take another quick break. Back with more questions for Gordon Reid in a moment. Stay tuned. Welcome back. Let's go to Anita. She's on the line from Markham, Ontario, with her question for Gordon today. Hi, Anita.
Good afternoon, Mirella and Gordon. Thank you for taking my call. My question is on Uber. I don't own it, but I've been wanting to get in for a long time, but found it very expensive. That's why I need your advice on it. Do you think it's a good time to get in? If not, if I have to wait for a dip, what would be a good time? What would be a good price to get in?
Okay, thank you for the question. So it's at 95.46 today. It depends on sort of what you expect from Uber moving forward, especially with the automated driving situation and competition that'll provide. What's your take?
Well, we see that as an opportunity, and this is a company that has really honed the model to the point where it's now financially additive. They're a cash flow machine. So if you look at the price, which I think is at an all-time high, obviously up and to the right, you're thinking, well, it's getting more and more expensive. I think in the way I look at it, it's getting less expensive, and I'll explain. Their cash flow, their earnings, their revenues are growing at a faster rate than the price is going up. So in my language anyway, this is a stock that's getting more and more appealing, less and less expensive on a valuation basis, which is life, isn't it? Everything is a value equation. So we would buy Uber today. It's in our US large cap portfolio, has been for a while. I wrote an article about, a blog about Uber that you can find on our website, goodreid.com, if you want to go there. And just go to Insights and Articles, and you'll find an article on Uber that really gives a broad explanation of why we like Uber and where we think the opportunities are.
Got it. Okay, let's go back to the phone lines. John is on the line from Kingston, Ontario. Hi, John.
Hi, Morella and Gordon. Thanks for taking my call. Gordon, I I'm at the top of the mountain here, looking over the valley, and I'm having trouble reducing my portfolio. It's almost like kicking your kids out of the house. Do I sell the ones with the biggest capital gain, or do I sell the ones with the lowest yields and then keep the better ones?
Mm-hmm.
Okay, thank you for the question.
That is a great question, because a lot of people tend to be motivated by tax and tax savings and lose sight of the whole idea of investment, and that is to make money. When you make money, you owe tax. I often say to clients, when we make an investment, we have a silent partner called the CRA. Mm-hmm. We are going to have to pay tax. And some clients go so far as to want to avoid paying tax that they make poor investment decisions. And that can be fatal. If you don't make the right investment decision, in other words, you make an investment or a decision based on tax, future opportunities will be diminished. And that is working obviously against you. So my answer to John is look at things from an investment standpoint and make the correct decisions from an investment standpoint. Capital gains are an offshoot of that. None of us like them, but they're part of life.
Okay. Hope he can follow that through. And we're going to move on to Sal from Vancouver. He's on the line now. Hi, Sal.
Hi there. Yeah, my question for Gordon is on Thermo Fisher Scientific. In the healthcare space, it seems like this company has done a little bit better than some of the others. And I was wondering, do you think there's more runway here, Gordon, or do you think it's still better to sit back and watch the whole space as a whole and try to see better market breadth? Thanks so much.
Thank you for the question.
You know, when I look at this sector, an industry, and another company we'd look at in this space would be Danaher. Life sciences company, diagnostics. A couple of things pop out, and one is that they're expensive. So they trade at a fairly high multiple, not only against the market, but against their own history, which is something to look at. But the other thing that pops out is that rates of growth of cash flow, earnings, revenues are falling. And part of that is because of the COVID echo. So a lot of the COVID applications are no longer money-making for them. And just generally, business in the healthcare area is tough.
Yeah.
So we would pass on Thermo Fisher and anything else in that space for now. These are good companies, but it's just not the time to buy them.
Got it. Okay, let's go to Bob from Glenfell, Saskatchewan. Hi, Bob. How are you?
Good morning, or good afternoon. Yeah, no, I'm fine. My question for Gordon is on Adobe. It's only a small portion of my portfolio, but I'm not sure whether I should just, and I'm down about 30%. I don't know if I should just turf it and move on, or if I double down. Thanks.
Okay, thanks, Bob. So a lot of different opinions on Adobe and their way forward, right? With AI sort of a threat to the products that they provide. What's your take?
We owned Adobe up until about 2 years ago, sold it on the basis that it was challenged. It was relatively expensive on a valuation basis. How they would transition into the AI world was a question mark. This is at the time that they had an offer out for Figma, and not getting Figma was a big deal in terms of our interpretation of what Adobe felt about their position. We felt they were jeopardized. So we sold it at higher prices, fortunately for our clients. And I still think that I would not buy this stock. And I think if you owned it, you would move aside or should move aside. And I think that's true of many software companies that are seeing their space challenged by AI, just a better mousetrap coming along that will make them obsolete.
Got it. Okay, Bob, I hope that helps you to make your decision. That is all the time we have for phone calls and emails, but Gordon shares new top picks coming up after a break. Join us tomorrow on Market Call. David Burrows on the show. He's President and Chief Investment Strategist, Barometer Capital Management. He'll take your questions on North American large caps. That's tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now to go through Gordon's new top picks, beginning with Booking Holdings, BKNG, on the NASDAQ, which is for travel. We talked about some other travel stocks you held last year. What do you like about Booking?
Well, Booking is the largest online travel company in the world, and it's sort of today's version of the travel agent of the past. And it's very efficient, it's capital light, asset light, and AI just fits in perfectly to what they do. So generative AI can point them in the right direction to generate future earnings for this company. They own companies like Booking.com, Priceline.com, OpenTable. Many people use that to reserve at their favorite restaurant. Rentalcars.com, Agoda, which is a Asian travel site. So they're well diversified. They have something called Connected Trip, which is a AI empowered ability to basically upsell. So if you're going on a trip, they'll say, congratulations, Marella, you're going to Italy.
Would you upgrading your room if you want.
Yeah, or would you like some help on excursions, or are you thinking about going anywhere else in Italy? We can set that up for you, and so on. So very profitable company, fast growing, trades about 25 times earnings, so it's not really challenging in terms of a multiple, and the growth has been relentless. This is the poster child for a compounder.
How long have you held it?
We first bought into Booking Holdings when it was called Priceline.com in the late 1990s. And have held it on and off since then. It was in our small cap portfolio in the late 90s. It's now in our big cap portfolio. We first bought it at $19 a share, and it's now $5,500 a share.
Yeah.
So it's done incredibly well.
All right, let's move to your next pick, which is Microsoft, which is MSFT, of course, on the NASDAQ. You like what they're doing with AI and with cloud.
Yeah, that's really the story is Azure, which is, quite frankly, beating the other cloud companies, whether it's AWS with Amazon or Google or Meta's offering, and they're doing a great job with that. On the AI side, the adoption of Copilot, which is their AI assistant, is ramping. They're well managed. They've appreciated in price quite markedly, but I think there's still a good value here at around 35 times, 34 times earnings, but growing consistently and rapidly. And we're in the early innings of AI. We think that we might be maturing, but this is just the beginning.
And I'm just wondering, for Copilot, are people who use Microsoft tending to use Copilot? I find everybody has their own AI that they like to use. So even if they're using Microsoft, they're not necessarily using the rollout with that.
Yeah, I don't know the statistics on the linkage between Microsoft and the Copilot, but I know that the Copilot adoption has been very, very favorable. So the natural assumption is that most likely.
Okay, let's go to your third pick, which is Piper Sandler investment, mergers, acquisitions, that kind of thing. What do you like about Piper Sandler moving forward?
Well, it's a mid-cap. So they have a very strong presence in that mid-cap mezzanine market, whether it's healthcare or even government. And they have brought on other companies, so absorbed other companies with specialties and relationships that go back perhaps decades in these areas. And capital markets business is built over a very long period of time. It's a business of trust. So you go back to the company that took the banker that took your company first public years ago, and we need to do a secondary, we need to do this and that. And they are very strong in that mid-market area. We love the fact that this is part of the next wave within the financials. There's a lot of pent-up demand because there were policy restrictions under the Biden administration to doing capital markets business. And we think the big bankers are going to do well. We own companies like Goldman and Morgan Stanley. But in the mid cap and small cap space, we like Piper.
And have you held them for quite some time, or is it a new acquisition?
We have held them over time.
Okay.
We held them. They did incredibly well. We sold off the company and bought it back.
Okay, so something you still hold now.
Yes.
Got it.
Yeah.
Okay. We will leave it there. Gordon, thank you very much for coming in. Good to see you.
Thank you, Morella.
And thank you very much for joining us on Market Call today. We will see you again tomorrow. We have a quick look at the markets as we head to a break.